All right, well, prepare for CPI, Consumer Price Index, basically our inflation numbers for the month of July, coming out tomorrow morning at 5:30 a.m. We'll be covering it live at the time. Make sure you're part of the course member live stream and Game Plan Alpha report right after that. But here are the numbers that you got to pay attention to. So tomorrow, we're looking for a 0.2 on that headline and 0.3 on core. But both of those are averages. I'll go through the averages in just a moment. But basically, they're average estimates by market participants who try to look at basically their own underlying baskets for how much inflation or how much consumer prices are moving. Goldman Sachs is one of those that right now is telling us that U.S. companies and U.S. consumers are absorbing about 85-ish% of Donald Trump's tariffs, suggesting that we should see broadly more core goods inflation in the coming CPI reports, and we could expect that to continue really for the rest of the year, which unfortunately, right before Jackson Hole coming up in less than 10 days here, could have implications for mitigating Jay Powell's interest in forecasting rate cuts, which of course is not what we want to hear. Right now, markets are pricing in 2.2 rate cuts almost fully here for the rest of the year. However, by January 28th, my birthday, 2026, we are pricing in a shot at about 3 rate cuts, knocking on that door, closer to about 2.7 fully priced in. And probably the only reason this is going slower, and Powell has said it himself, is because of the inflationary effects on core goods because of tariffs. Now, a lot of people refer to tariffs as sort of a one-time price hike. You even had one of the Trump staffers from the National Economic Council write a piece in the op-ed of the Wall Street Journal today. And what they did is they suggested that inflation is basically a tax, and it decreases income rather than affecting inflation. I suppose this depends on what kind of definition of inflation you want to use. If you want to use the definition of inflation of the expansion of money supply, this would be true. It's, tariffs don't increase or decrease the supply of money, right? But the way we colloquially understand the phrase inflation is that we want to know, hey, if I'm going to buy this calculator for $10 this year, how much is this calculator going to cost me in a year from now? And if in a year from now it costs me $11, then we've had 10% of inflation. And if a year later it costs me $11 again, then we've had 0% inflation thereafter, right? So a big spike and then a big drop. This is very normal. And so colloquially, the definition of inflation is really that change in price over time. And so as usual, you have, Trump administration folks trying to redefine things, which the Biden administration did too. We know what they did with the recession in 2022. Redefining our GDP declines. Although in fairness, they did have an argument that the labor market was very strong, which it was in 22, much stronger than it is today. But the redefinition or redefining by politicians is very common. But anyway, core goods is really what we're going to be paying attention to. So that headline number, we're looking at 0.3 with an average estimate of 0.29. The range on that is 0.1 to 0.4. Most of the sort of bell curve is between 0.25 and 0.35. I'm not so really worried about that headline number because oil prices and energy prices have been relatively stable, and there could be variations in food that generally make me not even want to speculate on what that headline number is going to be. I care a little bit more about that core number, and the worst case scenario here for markets tomorrow is going to be a number that's really high. Now, that's not really in the forecast. Right now, the forecast is also calling for a 0.29 read on core inflation. Now, do keep in mind that core inflation is different from core goods inflation. Core inflation is going to include housing services like rent and owner's equivalent rent, lodging, but also core services, transportation services, travel, medical services, insurances. Insurances lately have been the only real remaining driver of inflation in our economy because they're still playing a lot of catch up from the increasing prices for goods and other services that underlie those insurance expenses over the past few years. The way to think about this is just look at your car, for example. just because, in 2022, let's say the prices of, inverters for your electric vehicle or, I don't know, cylinder heads for your car or spark plugs or whatever, mechanic wages all skyrocket in 22. We didn't actually really see those costs start showing up at insurance companies until maybe 6 to 12 months later. And then insurance plans have to actually lapse and you have to get a renewal that's substantially higher than what it was. So you end up with this sometimes really a 2 to 3 year delay in insurance premiums rising. And that's been a contributor lately to inflation as well. Though even that has been collapsing. So housing services, non-housing services have really been collapsing and disinflating quite substantially. And core goods really post that COVID boom also disinflated substantially. But that's only recently now been rising again, unfortunately, because of tariffs, which again, Goldman Sachs suggesting that 85% of those tariffs are paid by US consumers or US corporates. So when we look at the core CPI estimate for tomorrow at 0.29, we have a little bit more of a narrow range here with also on the core side, much of the survey estimate really concentrating around that 0.3 handle, which is obviously why we have the average there. That number, I'll give you what markets are going to care about tomorrow, because where the estimates were, I think matters less. I think what matters more is that if we end up getting a 0.45 tomorrow, understand that is going to get rounded up, and it's going to be very painful to markets, especially the bond market. I think that's partly one of the reasons why we saw a little bit of a sell-off into the close in markets today. I was actually really blown away because the first half of the day, I said, hey, folks, I told everyone in the Alpha report this morning, I go, watch the 571 line. It's an uptrend line, about 57150. I wrote it in the Alpha report this morning so you could see it. And I'm like, but what I think is going to happen is we get a drop out of the gate and then we'll rally. We could go as high as 80 basis points up on the Qs. That was the second call of the day. My first call was Tesla, that it would hit 347, which it came within 36 cents of that after a pretty dang solid, 1% rally turned into a nearly 6% rally, which was a fantastic call for trading purposes, which is great. This is why I love doing the Alpha report every single morning. But I will say I was surprised when I came back later after lunch and some commitments I had to do to see that the Qs actually bled out after this rally, after what played out. And we actually bounced at the end of the day, like the closing minute over here, we bounced at my line. Now, this is an uptrend line, so, this isn't like a scary line. If anything, it's actually quite a bullish line. If you zoom out, this line is part of our Nike swoosh recovery. This is the coin we termed in 2022, basically predicting that as people got comfortable with inflation going away, we would have a Nike swoosh recovery, which is broadly exactly what we've had. And so the upper portion of that swoosh is that line that you actually see here, which looks like a flat line. Well, I mean, not really, but it looks a lot more flatter here on this chart than it does in the other one. But the point of this is to say, markets tomorrow are, I think, after CPI, either going to bounce off this line and we can march on higher, or we're going to lose this line tomorrow, and a lot's going to be based on the CPI report. So the danger handle for tomorrow is anything with a 0.4 on that core goods side, or deadly is like 0.5. Because if we get a 0.5, that's when we're really going to start talking about stagflation. That's when we're going to get concerned about no rate cuts this year. The bond market's going to sell off and yields will go up on the 10-year again to like 4 or 5. It'll be terrible. You'll have your mortgage company sell off again, all the usual. Ideally, we have core services and housing services and non-housing services. Ideally, those come in so low that they offset the pain of tariffs. See, if it weren't for tariffs, we would probably have like 1% inflation right now, or maybe even 0% inflation. Tariffs, unfortunately, are just sort of putting fuel back on a fire that's almost out, and it's very frustrating because, now Donald Trump can essentially cheer like, oh, inflation's close to 2%, 2.5%, it's only slightly high. Yeah, well, it would be way lower for people if it weren't for tariffs. So, like, ironically, that 2 handle being a cheering point is ironic because it's like, well, it'd be lower if it weren't for tariffs. But whatever. Woulda, coulda, shoulda, I suppose. So, again, if we get a 0.4 or worst case scenario, 0.5, it's going to be really bad. I do think we'll end up losing that uptrend line, at least in the near term. And Jackson Hole is going to suck because Jay Powell's going to hawk at us. And Donald Trump's going to be pissed, and it's just going to create more tension for the markets and more concerns about, oh my gosh, like how is the Fed actually going to get us out of this stagflationary situation now? So those would be really like your worst case scenarios. We don't want those to happen. Those would be bad. Ideally, what happens tomorrow is we get something just straight up in line with expectations. We get a 0.3. It ends up averaging up, so it was really like a number like a 0.28 or whatever. And then we look at the little components and we're like, okay, you know, core goods are high again. They're growing at an annualized rate of 5 or 6 or 7%, but all the other stuff is negative. So we're kind of like averaging 2%, which then we can kind of try to push Powell to invoke the flexible average inflation targeting fate, which he's tried to unwind in the past, and then he's brought back. He's been very confusing on what their policy is on fate. I kind of think he sort of keeps it like in the back pocket for when it's convenient for him. But that said, I do think tomorrow is a pretty important report. It's probably the most important catalyst of this week. Earnings broadly much less interesting this week, although we will get Circle and CoreWeave, which I'm broadly bullish on those. We'll talk more about those in the Alpha report tomorrow. But I don't play earnings, you know that. But I'll still give you my insights and thoughts on how to play things. But that said, yeah, CPI tomorrow will be at 5:30 a.m. There are some estimates out. And so it's just in addition to kind of what I've already talked about here. The estimate that Nick T put together, which I thought was a useful chart or sheet that he put together. I might disappear here for a second, but that'll be okay. Yep, okay, I disappeared as I thought. So here just sort of by banks, the different forecasts. And so he actually has this sheet over here that shows a median forecast of 3.1. That's actually slightly higher than the forecast that I gave you. I gave you 0.29 basically. Well, oh, I see. Okay, this is the year over year. I'm sorry. Here's the month over month figure. And yeah, 0.31, right. I gave you 0.29. Yeah, okay, sorry. I'm confusing myself here. So my figure here is 0.29 based on the about 40 or 50 surveyed economists. I'll tell you exactly in just a moment. This is just based on these particular banks here. And these particular banks actually average to a slightly higher read on that core month-over-month figure, which is not ideal because it would be a market increase from what we've seen in the prior month from the June numbers. So not ideal. But again, it shows you that the bias is to the upside here, and this is based on 63 qualified economists is the one that I'm looking at, with about a half, well, it's like 0.06 percentage point standard deviation, so 6 basis point standard deviation. So 2.9 is the number for core. Again, Nick T's banks over here, 0.31. If we can get that number low, great. Bullish catalyst, like push the button, where is it?
Bullish catalyst.
Kevin's somebody we'd consider. Kevin is fantastic, too.
Kevin is very talented, but I don't know if it's going to be him, but he's a very talented guy.
Like, it'd be a great thing. So, you know, fingers crossed for that. I will be covering this, obviously, first thing tomorrow morning. So I hope you join me and then make sure you're part of the course member live stream and the Alpha report as we'll get to go into detail on potentially what trades to look at in reaction for the CPI numbers. And a lot's going to come down to the magnitude of a miss. If we get something that's broadly in line, you know, we could have a nice sort of bounce rally on China trade extensions or whatever. If we get something that's really ugly to one side, we're going to really want to watch bonds and mortgage plays and real estate plays and others. And then, yeah, we'll give you some breakdowns there. Quick update also on House Hack. We continue to, you know, I mean, the CPI report tomorrow will be useful as well, but based on what we're seeing in the labor market, we do think that it's quite likely that, and it's not guaranteed yet, but it's likely that we're going to end our fundraise for House Hack in September, as Jerome Powell probably capitulates and gives us maybe even a 50 basis point cut. We do think that at that point, paying out a 5% yield isn't necessary, and it's going to come right before us launching our AI product. So we think that it's unnecessary for us to pay out our rental yield. We're paying out 5% on the current round, and we think the valuation is, it doesn't price in any of the tech, in my opinion. So everybody has been asking me, hey, give us, if you can, just give us as much notice as possible when you end the fundraise. That's not set in stone yet, but it's just what we're sort of circling and targeting right now. So if you want to learn more, go to househack.com, read the investor packets and informations available. The information sets available, like the private placement memorandum or the offering circular for the Reg A. Remember, it is open to non-accredited investors. And if you want to learn more, go to househack.com. You could also email us at ir@househack.com. Remember, we pay you a 5% yield. That's basically just paying out our rent plus 100% of the upside in the stock. So you get paid monthly, you get all the upside in the stock, and you get paid on this sort of monthly basis through conversion. The earliest that could happen would be 27, I believe it is. Can fact check me on that. That's the earliest, but that only assumes that our stock is worth more. So anyway, check that out, househack.com. Appreciate y'all. And then remember, use coupon code JHOLE at meetkevin.com. You pay once, you get lifetime access. So every day when we give that perspective on trades or trade alerts or whatever, you get to be a part of that. If you're in the Meet Kevin membership, we use our Meet Kevin app, which you can download for free. Anybody can download the Meet Kevin app, but you only get the course member portion, the alpha report, if you're actually a course member. So check that out in the Apple and Android App Store. It's super useful and functional for everyone. Anyway, thanks for being here, and good luck tomorrow on CPI. We'll see you in the morning stream.